Welcome back to the Real News Network. I'm Paul Jay in Baltimore, and we're continuing our dissection of the Democratic Party debate that took place Thursday night. We're focusing on the issue of financial regulation and Wall Street and what to do about the big banks. Well, in part one, I'm hoping you watched part one, we talked about Hillary Clinton and her support for and considering Dodd-Frank, the piece of legislation that is supposed to regulate and control too big to fail. Now, in part two, we're going to focus on Senator Sanders' proposal to break up the big banks, and here's a clip of what he had to say in the debate Thursday night.
Senator Sanders, Senator Sanders, you were recently asked what you would replace the big Wall Street banks with if you could break them up. You said, quote, that's their decision. Why would you trust the banks to restructure themselves?
All right, first thought. Donna.
When you say their whole business model is fraudulent.
That's right. So let's start off with the basic premise. A few days ago, Goldman Sachs formally reached a settlement with the United States government for $5 billion. What Goldman Sachs acknowledged was essentially that they were selling fraudulent packages of subprime mortgage loans. Goldman Sachs was not the only bank. Other banks, of course, did the same. Now, I don't need Dodd-Frank now to tell me that we have got to break up these banks, A, because they're based on fraudulent principles, and B, because when you have 6 financial institutions that have assets equivalent to 58% of the GDP of this country, they are just too big, too much concentration of wealth and power.
But Senator,
point is, we have got to break them up so that they do not pose a systemic risk and so that we have a vibrant economy with a competitive financial system.
But Senator, you didn't answer the specific question, which is not just about breaking up the banks, but why allow the banks to do it themselves?
Because I'm not sure that what the government should say is you are too big to fail. You've got to be a certain size. And then the banks themselves can figure out what they want to sell off. I don't know that it's appropriate for the Department of Treasury to be making those decisions. What we need is to make sure that they are safe.
So let's start with Bill. Oh, I'm sorry, I don't think I've introduced you guys yet. So now I will introduce you. Joining us once again, first of all, from Kansas City, Missouri, and on the right side of the screen is Bill Black. Bill's an associate professor of economics and law at the University of Missouri, Kansas City, white-collar criminologist, former financial regulator, and author of The Best Way to Rob a Bank is to Own One. He's an advisor to the Bernie Sanders campaign. On the left side of your screen, and I'm not suggesting anything political in terms of ideological gravitation here, in terms of who's on the right and who's on the left side of the screen. Joining us from Concord, New Hampshire, is Paul Hodes. He's a former U.S. congressman, former national co-chair of the Obama campaign in 2008. And Mr. Hodes, as we talked about in part one, voted against TARP. Excuse me. So, Bill, let me start with you as you're advising the Sanders campaign. I thought that was a pretty good question that came from the CNN journalist. I'm not always a fan of their questions, but I thought this one was particularly good. Why would you let the banks decide how to break themselves up, not only from the point of view, given that they're based on fraudulent principles, as Sanders says, but if they break themselves up in a way that's conducive to their fraudulent principles, then why don't they just get smaller, but in a way the same pools of capital control them anyway? And how does just breaking them up really going to change anything? We saw the telephone companies broken up. In the end, we wound up with a few other big monopolies with enormous concentration of ownership. So how do you answer that question?
Okay, so I thought it was a good question as well, by the way. And I thought that the key, which he started to answer, was to break it up into the critical elements that you needed to talk about. So you can't just break up a fraudulent institution. You have to get rid of the fraudulent leadership. And I thought that's where he was going with the discussion of Goldman Sachs. One of the terrible things, we've talked about the fact that nobody gets prosecuted, but on top of that, there has been one, and exactly one, fairly senior executive who has actually had to pay money out of their own pocket in a civil suit brought by the government. And of course, it's a woman from Bank of America, right? So all the other executives have gotten off with and made wealthy by the fraud proceeds and the bonuses and such. And they haven't lost their jobs. So it's far worse a failure than simply the failure to prosecute. And even very conservative people like the president of the New York Fed now are talking routinely about the corrupt culture of Wall Street. So you're absolutely right. You have to start with the fraud. You have to get rid of the leadership. And we have the tools in the Justice Department, but also at the regulatory agencies to do exactly that through removal and prohibition actions. And in addition to those 1,000 successful felony prosecutions, we had well over 4,000 successful enforcement actions. Indeed, I was, one of the enforcement heads in all of this. So you're right. You got to get rid of the fraudulent people who are running these places, and you've got to get honest people in. Second step is break up, even if they're honest. You simply cannot have institutions of the size that when they fail, and again, they will fail. It's just it's a matter of time for any individual bank until it will fail over a broad historical spectrum. And when you're dealing with 25 of them, the probability of when the next one will fail within, next decade or so is really very high. You cannot have that. We have seen why you cannot have that. And we have seen that they're treated as too big to jail. And we have seen the enormous political power that arises from this. And we've seen that these places are too big to manage. So it's a win-win-win for efficiency, for honesty, for the restoration of an effective democracy to break them up.
And now, Bill,
when you do that with honest leadership, then Bernie is quite correct. You tell them, you got 5 years to shrink. You're the experts in running the place. You figure out how to shrink. That's how I would do it. How we did do it as regulators. And that's certainly been my advice to Bernie.
Paul?
There's a lot I agree with in terms of what Bill says, and I understand what his advice to Bernie has been. Busting the trusts harkens back a long time in American history. Teddy Roosevelt was famous for it. There have been lots of industries that have been forced to change, often with little or no impact, as far as I can tell, on either the institutions, their practices, and what it really means for the American public. Recently, the New York Daily News had an interview with Senator Sanders that I thought was striking for his inability to discuss in the kind of detail that Bill just did the basic tenets of his plan and his thinking about banks. Because really what we're talking about is that because the banks are large in and of themselves, because a part of the investment bank practice turned out to be fraudulent, and let's just agree that it spread across huge numbers of sectors of the banks, the regulatory agencies, the failures were multiple, the credit rating agencies, multiple failures across the financial system. In and of itself, he says that it's the size of the banks that's the problem. And in fact, since the financial collapse, there's a good argument. I think it would be hard to argue with that there's been consolidation in the banking industry, which may not be helpful. So what I really find problematic is is Senator Sanders conflating the issue of monopolies and size with the issues of what ought to happen on the regulatory front. And I also am thinking about the fact that there are things that Wall Street does for the American economy which need doing. The 21st century innovation economy is fueled by an enormous flow of capital, and we can argue about whether that's healthy or not healthy, but it requires an enormous flow of capital for innovation and startup activities. And the same Goldman Sachs, which, by the way, just paid a rather large fine in connection with the activities of theirs that were fraudulent, also provides that flow of capital, as do many other banks. It could happen if they were smaller, I'm sure, and it could happen if there were more institutions. But in and of itself, breaking up the big banks is a nice rallying cry. It feeds into the justifiable anger the public has about what happened and what the consequences have been. But in and of itself, it is not a prescription for curing the illegal penchant that Wall Street or financiers may have, irrespective of their size. If you take a look at the size of the units at the financial institutions which created these crazy derivative instruments, the physical size and number of people in those units, they were disproportionately small to the huge profits that were being generated. We don't have to argue about whether or not they were good, bad, or indifferent. They were bad stuff. It was illegal activity, but it happened in relatively small parts of the bank. So simply breaking up a bank, you could break Goldman Sachs into 12 different pieces. You could still have similar activity. They're different issues. I think Senator Sanders, with all due respect, conflates the issues and doesn't have. I'm glad he has people like Bill advising him, because if he is the president, Bill will have a good and outsized influence. And Bill sounds like he knows what he's talking about.
Bill, I don't assume you'll disagree with the final sentence. What do you think of the rest?
No, and nor do I. I'm a banker in part by background, so I certainly see honest bankers as being a very useful function. But the dishonest bankers, the best estimate from economists is that through the course of the Great Recession, we will lose $24.3 billion in GDP. We lost 9.3 million American jobs and 5 million that were not created. Latino college-educated households lost over 70% median of their wealth. Black households with head of household with a college degree or beyond lost over 60% of their net worth, again, a median figure. So there are staggering losses because of all this. And in economic terms, the banks systematically misallocated capital, which is the opposite of what they're supposed to do. And you know that because that's what creates bubbles. And while it is true that small units can create lots of problem, it's only because they work for big units. In other words, the Merrill Lynch folks that created so many of the financial derivatives that blew up. Well, yes, that subsection may have had only 600 employees, but the only reason they were able to function is because they were part of Merrill Lynch. Otherwise, they couldn't have done any of those deals. And by the way, they sold overwhelmingly to Merrill Lynch as well. We call it eating your own cooking. So I think that Senator Sanders actually has a pretty sophisticated understanding of these things. He's gone to advisors to build on it. And I would say the New York Daily News, which thought, after all, that he was the mayor of Vermont, was more confused. And by the way, it was wrong. When Senator Sanders gave his statements about the role of Treasury and the Fed on breaking up these institutions, he was correct and the New York Daily News was incorrect. So Again, these are things that nobody has to scream. Nobody's screaming during any of this. There are better ways to do all of these things. And the sad thing is, the President Obama had a unique political opportunity like FDR had. And as I said, not a single one of these institutions has been broken up. Not a single one of the executives has been prosecuted. If you don't think it's a corrupting influence of money and power, what do you think it is?
I don't think, however, that simply breaking up the big banks as a rallying cry, it's a good rallying cry, but I don't think that anything, given our regulated market economy, I don't think that anything will ever stop greed, corruption, and damage from occurring. It is a simple fact of life in America and in a capitalist economy. And Senator Sanders, as a social democrat, may have real problems with the fundamental nature of a regulated market economy, which produces greed and illegality on a regular basis. But not to say that all the other systems around the world don't have their own share of greed and illegality. There is no one thing that can stop it. As a former
Paul, I think you raised this is really the nub or critical part of all this. After listening to both of you, if you put the argument together, I think you both agree that if you just break up big banks, it's not enough. And Bill makes the point that you have to deal with the culture of fraud and corruption and such. Paul makes the point that this regulated market economy, almost spontaneously engenders fraud and corruption. It's kind of inherent in how it works. On the other hand, we're also saying regulation really isn't working because of the power of money. I know I've talked to Bart Chilton, who was at the Commodity Future Trading Commission, I think it's called. When they were trying to pass this new regulation on position limits, he was being lobbied something like 1,000 to 1, literally, like 1,000 lobbyists who were for less regulation for one who was fighting for more. So you put all of that together, you don't get to any change. Dodd-Frank's not effective because, let me just hang a sec. Dodd-Frank isn't really effective because so much is in the realm of regulation. At the level of regulation, the lobbyists have such enormous power. This idea that you could just regulate away the fraud or prosecute away the fraud and then break up the banks. Where I'm heading here is kind of what Paul was raising as the question. Is there not some need for some form of public banking that hopefully one would have more control of? If you go back to the healthcare debate, like a public option, but something on the scale that can deal with these massive flows of capital, not simply having some consumer banking at a post office, which is not a bad idea that Sanders has supported, but it doesn't deal with the big structural problems.
Paul, way back when I was contemplating TARP, and I have to tell you, let me admit that I came to the issues of our financial system as a relative neophyte. Not completely. I'm not a total dummy, and I wasn't completely uneducated about it, but I got a rapid education serving on the Financial Services Committee with the help of very smart people on my staff, and had a crash course during the crash in financial regulation. But at the time, I took a look. I think it was at the Federal Home Loan Bank. And Bill, you can correct me if I'm wrong. I think that was the 40s, maybe, when the Federal Home Loan Bank came in. And I wondered, why don't we take a look at a model like that, where, like the public option, folks have a real option for financing outside the private banking system. And then you get into arguments about, well, is the federal government really equipped to do that kind of business? And Paul, you're talking about a fundamental tension in our democracy between a representative democracy and a capitalist economy. Our market cares about profit. The government cares about people. And there is a built-in tension between a representative democracy and a capitalist economy, which only cares about profit and really doesn't care about its effects on
And
people.
let me add, I appreciate you voted against TARP, but eventually it passed. Now, you have this private banking sector completely dependent on public bailouts in order to carry on this kind of activity.
Well, you know, the idea, at least the idea behind Dodd-Frank, was to provide a regulatory framework to prevent that from ever happening again. And I would say that both Democratic candidates, whether or not we agree or disagree with their overall philosophies and the specific elements of their approach, both Democratic candidates are talking about financial regulation with at least a view towards preventing or trying to prevent the kind of damage that we experienced. When you look at the other side of the aisle and think about what it would mean for a billionaire like Donald Trump, or a Satanist like Ted Cruz to be in charge of our country and its economy, let's just remember which side of this aisle we need to be on.
Okay, Bill, let me pose the same question to you. I understand the need for stronger regulation,
I got the
prosecution and so on, but in terms of this structural problem, don't you need something like a robust public option?
All right. So first, the congressman and you are both correct that we're talking about, when we talk about breakup, we're talking about a necessary but not sufficient condition. And to briefly put a different hat I wear on, the Bank Whistleblowers United, a nonpartisan group, has detailed proposals on how to change a lot of things that would be very useful. And certainly people like me give broader advice to Senator Sanders as well. Second thing that the congressman and you are bringing up is the incentive structures. And first, we should be so lucky that the banks are trying to make profits. Banks can't do anything. People do things. And the officers are the ones trying to make money. And often the best way, setting aside morality and law, for the officer to get a sure thing is to do things that hurt not just consumers in the nation, but hurt the bank as well by causing them to make or purchase enormous amounts of bad loans. So how have we gotten into a system that has these perverse incentive structures? This is something that, by the way, there's broad agreement in the academy on, from folks from very conservative spectrum as well, that we have changed things institutionally, like getting rid of true partnerships, which had joint and several liability. Where we have adopted a compensation system, not just for senior executives, but throughout the ranks, that creates these perverse incentives, that allows senior officers to create what's called a Gresham's dynamic, in which bad ethics drives good ethics out of the marketplace of the profession. And the specific example the congressman has brought up twice correctly is the credit rating agencies. Well, how do you do that? You don't give your business to the credit rating agencies if they're honest. You only do it if they're willing to give preposterously inflated ratings, in which literally toxic waste, as we use that term in finance and have used it for 25 years. This stuff had been called toxic waste for 25 years. Suddenly it was AAA, which is the highest possible rating. You know,
just very quickly, for people that aren't following all this so closely, Bill's talking about a massive amount of loans for houses, mortgages that everyone knew the people would never be able to pay, and they were packaged, and then the rating agencies called them AAA, even though anyone that looked at them knew that even half the documents hadn't even been signed properly.
Right, but this happens for reasons. It's not inherent in capitalism. It's because we have changed the structure and the incentive systems by moving away from true partnerships, by moving to these compensation systems that act functionally as bribes. So Do I think there's a role for the public sector in banking? Absolutely. I think a very large public bank for consumers, for regular people, that doesn't do all the nasty things that regular banks do, is a very good thing. And the Postal Service is the right way to do that. It's been used for centuries in some places. But I urge you not to think that having a public bank solves the problems that we're talking about more generally, because you can look all around the world at public banks and see that they are frequently corrupted by their local or national politicians. And Brazil and Malaysia which is not a bank formally, but it runs like a bank. It's a massive investment fund. Show you that you shouldn't be putting all of your eggs in that basket either.
You know, Bill raises a very interesting point. If you think about the current state of the investment banks, including their size and the fact that they're listed on the public exchanges and you can buy and sell their stock, and that the folks who are running those huge institutions are now responsible to their shareholders for their operations and showing profits. And you think back to at least the time, and I'm old now, but the time when I was a kid, the quiet partnerships that were investment banks and on Wall Street represented a very different breed. There were partnerships of long standing. The partners were responsible to each other. There was joint and several liability, as opposed to having the shield of the corporation in terms of liability for bad acts. And that migration or progression of the banks from the smaller investment organizations, which provided funding for business, to the mega corporations we have now, and the huge amounts of money that are floating around, is an interesting history in the context of the collapse that we've experienced and the arguments around what to do.
Okay, Paul, this is a big conversation, and it's an excellent one, and we should pick this up again another time. We're just to wind it up now, and I really do want to pick this up again. Bill, just in a word, I mean a sentence or two, you know, given the complexity of this whole thing, given the enormous power of such concentrated wealth on Wall Street, and the power it has over, you know, the Congress and the White House and the regulatory agencies, why do you think Sanders is more likely to take this on in a way that's better for people than Secretary Clinton?
Okay, so my wife's colleagues, very conservative, have just written the book on this subject, and the title summarizes the answer. It's entitled Better Banks, Better Bankers, Better Banks. And it gets at these incentive structures that we've just been talking about. Senator Sanders is taking his advice from people who are pushing for precisely the kind of institutional changes that the congressman and you, and I hope myself, have all been explaining. And I endorse entirely the congressman's point. Look at the other side of the debate. The Republicans are all about how they're promising to destroy regulation.
Okay, Paul, same question to you. In the final analysis, why do you think Secretary Clinton is a better choice in terms of battling these such political financial power?
Well, first of all, let me just say that now that I know that Senator Sanders is getting his advice from a smart guy like Bill Black, it almost gives me pause, but not quite. I think that Madam Secretary Clinton has a more sophisticated understanding and simply better equipped to deal with the complexities of this issue than Senator Sanders, whose underlying motives I appreciate and agree with. I think I'm not a one-issue candidate. I still think that Hillary has the right approach and a better approach to use and build on the existing legislation to prevent the systemic risks. And we need to look at the regulators, the implementation, the prosecutions. And I trust that Secretary Clinton means what she says. No banker too big to jail. And I trust her on that.
Okay, gentlemen, thank you very much, and I hope we will pick this up again soon. And thank you
Thank
for
you both.
joining us on the Real News Network.